So without further ado, let me introduce Grainne. Thank you so much for coming.
Thanks so much, Matthew. It's my absolute pleasure to be here. And sorry to interrupt the lunch hour and your food. But I'm delighted that Matthew set me up the way he did by saying that this is not just for investors like yourselves and family offices, but for the world. This is a time of incredible innovation in technology, much more quickly and rapid and overwhelming than we've perhaps ever seen in our histories. And PwC spends a lot of time on this. And when we issued our global CEO survey to the Fortune 500 companies that we deal with, the advancements in technology came back as the most profound issue that CEOs, that it's keeping them up at night, right? This was bigger than all of the other things we talked about today, including urbanization, dislocation in terms of global economics and wealth, and where that wealth is actually coming from, technology advancements and the ability to drive innovation, harness that innovation, and the ability to really have the skill set inside the company to harness data and digital innovation is really a preoccupation across all of the clients that we deal with. So I do want to break it down. I want to tell you how this is manifesting itself in the area of blockchain. I want to explain blockchain. I spent the last 2 years really telling our clients that I really don't speak about cryptocurrencies. It's a specific implementation of blockchain, but I'm much more fascinated and interested in the underlying technology that powered the Bitcoin network and what's happened with it since. So I will explain that to you. I don't get away without talking about crypto anymore, and you'll of course appreciate this, and I want to have a little fun first and show you a video which will, I think, indicate the point why I have to talk about crypto. Hopefully it will play for us. It's a little fun as you continue to munch. Let's see if I can make it play here.
Broke, unemployed, I was starting to slouch. I was sleeping in the basement on my mama's new couch. That's when I heard it all. A chances heard it all. A money like my last girl. Shot the top, graphic cards, got a power supply. A microprocessor, a motherboard, a tower and drive. I put the RAM in the RAM slot drive in the larger bay. Topped it off too fast, like a Chargers game. Right to 30, I missed out, I fear. Crudely assemble a rig like a BB engineer. My friends and family smiling, smirking on like fun of me. But I'ma make them eat their words because I wanna be a Bitcoin millionaire. Spending money like I don't care. Mighty coin in my underwear. I'm gonna be a Bitcoin millionaire. Selecting software and reading the notes. I'm picking out my favorite. Mine is like a Penn State coach. Pick me a digital wallet for holding all my amounts. Read up on all the ways to open lots of accounts. I feel like Tom Brady. I got a fear of inflation, but this is crypto, baby. Central bank decentralization. The script I flipped it, laptop encrypted. My life was rotten, now all my cotton's ejected. On my vacation, I'm crypto supplying. They call me gentrification. The way I'm black modifying. Friends asking, what's the best part of your newfound treasure? I say, reminding you, have you told me I'll never be a Bitcoin millionaire?
So you guys get the point. Quite a lot of hype, and in particular, obviously, going into the holiday season here in the United States, we had something of a frenzy in cryptocurrency markets. I'll try to explain a little bit what I think are some macroeconomic drivers that led to some of that. But before we get there, Matthew obviously gave you my background. Just to put it in context, I did spend over 20 years in large financial institutions. Most of that was at Goldman Sachs and Morgan Stanley. And so when I joined PwC, and it was post-crisis, and I dealt with a lot of the fallout from the crisis, and banks obviously dealing with a tremendous amount of legacy infrastructure and a unbelievable, overwhelming set of new regulatory requirements that they had to actually adhere to. And the blockchain, in the context of financial services, seemed extremely interesting to me, and that's sort of where I latched onto it. Now I go cross sectors, and I'll explain where I actually see some more traction, not just in financial services, but way beyond, using that particular technology. So all of this, if you sort of take a macro picture again, is about what I talked about a moment ago. It is about innovation. It's about how are people using the digital transformation of their companies, and in particular the data, and taking that data and harvesting that as an enterprise asset, and how does that manifest itself in these new commercial models that we're seeing. I'll try to explain that. And also this theme of decentralization. How is that happening? People are calling blockchain the decentralized internet of the future, the internet of trust, the internet of value transfer, and I'll explain why it is that they say that. So I mentioned that there are all these technologies. It's overwhelming. It's really difficult to keep on top of all of them. On this page, you'll see some of the technologies that are prevalent and that we think matter and will actually change the face of certainly the companies that we deal with. So we tried to boil it down. And PwC wrote a piece called The Essential Eight. And on this page are the technologies that we really think are the ones that people have to pay attention to, because these will have the most profound effect, particularly on the corporates that we're working with. You'll see on this page that blockchain is here. So let's explain what is blockchain. So I mentioned to you that blockchain is not Bitcoin. A lot of people completely confuse these two things and conflate them and think that they're the same. Bitcoin was a cryptocurrency that was implemented on top of a blockchain ledger. So let's break it down and talk about what is a blockchain ledger. So blockchain at its core is a peer-to-peer distributed database technology, okay? So the notion here is that you participate in the ecosystem, you participate in the ledger, it's commonly referred to as a ledger, by having a node. Now, we see different implementations of this in the market in terms of how are these nodes set up. And the node could be an initiator node in the network, meaning this node is allowed to add data into the ledger. Or the node could just be an observer node on the network. So think, for example, auditor, regulator, overseeing a particular system like the financial services system, for example. Those entities could be observer nodes on a blockchain. Okay, you have a third sort of concept here, which is the concept of a validation node. One of the things about this blockchain ledger that's holding data is that the data is immutable and irreversible. So when a block is added to the chain and it's accepted via a mechanism that's called consensus, in other words, there's a validation mechanism that's that the parties in the network have agreed to, that will govern how the data will actually be allowed to be inserted into the network. So think about this for a moment. You have a couple of key concepts here. You have a notion of consensus. Now, you may have heard about consensus in the Bitcoin network because it was very complex. It was brought about by mining, right, which is the joke that we saw in the video. But the idea was that you had to demonstrate, you had to dedicate a lot of computer power to solve very complex algorithms, because of course this is a public network, in order to claim that you had a stake and that therefore what you're adding to the network was in fact bona fide. In the instances that we're working with, most of these networks that corporates are building, new ecosystems, new marketplaces, and I'll explain what's happening in these marketplaces, but these are private, permissioned networks where the parties in that ecosystem get together and they decide how will access entitlement work, right? So these networks make use of cryptographic signatures. Now, cryptography is nothing new, right? It's been here since the dawn of the internet. The use of private keys and public keys in order to access data that's held in a public infrastructure. But the notion here is that this particular science of cryptography has gone on steroids inside the blockchain community. Why? Because people are very focused on preservation of identity, preservation of personal information, disruption of companies that are taking people's personal information and monetizing it, so that the value of that data could actually be monetizable by the individuals who actually own it. So this notion of protecting data, protecting identity, and having networks that are decentralized but are still safe has become something that the blockchain community is really fascinated by. Of course, you will have read some of the scandals in the press about hacks into these networks that had wallets in them, and exchanges, for example, where people's wallets with their bitcoins were stolen or compromised. And so, of course, none of that helps. But what we're really talking about is, again, private permissioned networks where there is this notion of governance, which is illustrated through the consensus mechanism, which validates data coming onto the network, and the public and private keys and the way that those are administered, so that access entitlement of the actors on the network is also trusted. So, why is this different than things that have gone before? I get that question a lot. I say, people ask us, we have other technologies that do some of this, and the answer is really no, we don't, because there's one other piece that gets added in here, and that is the notion of a smart contract. Now, the smart contract sort of became popular in one of the particular blockchain fabrics called Ethereum. You may have heard of it. And Ethereum sort of came along with these smart contracts. And what are smart contracts? Well, they are a way to basically digitize contractual obligations across parties. It could be bilateral, it could be multilateral. But the notion is that, again, we're going to digitize the rights and obligations. We're going to code in an algorithm. We're going to deterministically indicate what will happen when certain triggers are met, and therefore, how will the process of value transfer between me and you actually occur, right? And then we sign up digitally to having that be contractually binding. Now, these smart contracts the enforceability of them is being tested in the courts at the moment, because, of course, they're replacing paper contracts with people's physical signatures, and as you know, in some industries, that's been very challenging to get the industry to accept that digital signatures actually matter. I give you the mortgage industry for example. People have been working on that for years. You probably personally went through an experience such as that where it's not possible to go all the way with the digital signatures, and at some point you have to sign something. But the notion here is again that this is more powerful than other forms of digitization because you have these smart contracts which are contextual to the business arrangement, but then you have a link between that business event that happened in the real world and the underlying data that got stored to the ledger. Now, when I talk to people in our clients in finance and operations, they tell me they spend their whole lives reconciling information that they see on ledgers with the street, third parties, other people outside, suppliers, customers, whoever it is, the bank. And part of their job is adding back on the context to what they're actually looking at. So these companies are thinking that this technology is so powerful to have a ledger that is shared, for example, between me and my customer set or me and my vendor network, wherein we are getting rid of the notion of the artifacts, for example, of invoices and goods receipt notices, right? We don't need them. Purchase orders, we don't need them. And if you take this one step further and you recognize that industrial Internet of Things and Internet of Things is everywhere and sensors are everywhere, you start to say to yourself, oh my gosh, we have the ability to track physically where goods and services are, where goods are actually going. And we have the ability to record that into this ledger such that we are able to digitize that entire flow from the customer ordering a part all the way to that part being shipped, all the way to that part actually being paid for, because we know it physically showed up at the GPS coordinates that are equal to the warehouse, and so on and so forth. So as we start to extend this, it becomes extremely powerful. So again, why would people use a blockchain? Well, and a blockchain isn't suitable for everything, right? The notion here again is you're going to take certain enterprise assets and you're going to start to share those with the network that you're part of. And so people get really scared about that, right? Many of our clients get really scared even at the notion of public cloud and going to a public cloud with their secure data. And so we have to bring our clients on this journey. Those clients that are further along in that digital transformation, we believe are the clients that will be most successful in the future. Why? Because they have an intentional strategy around data, open architectures, participating into open communities where unbelievable innovation is happening and onboarding that back into their companies, monetizing data that they have, right? So they've figured out already in this new internet of the future, let's call it, where we're not just sharing data, but we're also sharing digital assets, right? And we're monetizing those. If I can figure out what are the digital assets that actually I can create, and what are the partnerships in that ecosystem where I can actually add value, and we're seeing unbelievable innovation happening, even in terms of bundling of products that you wouldn't have seen before. I'll give you an example. When we sit down with life insurance companies, and it's probably not lost on you that many millennials do not buy life insurance. And when we talk to life insurance companies and we say, well, hold on a second, you're selling the business of being dead. How about selling the business of being alive and being well? And so wellness becomes a big focus for these life insurance companies. Partly because they can use the data in their actuarial models and price the products better, but also because they're interested in creating an ecosystem where it looks like the customer experience is one that the customer actually wants, right? I have the ability to promote healthy well-being and therefore to reduce the price of catastrophe insurance, in this case of death, right? And so, again, we're seeing these kind of collaborations across industry sectors. We're seeing the lines across industry sectors being blurred. Why? Because this technology is here. Now, I could also argue it's not just the technology, and I know you're thinking that it has to do with other shifts in the way the customer is actually demanding this, and I'll explain some of those macro trends in a second. Let me give you some examples of where this technology is being used, right, that are real, that are live, that are out there. The one that is a sponsor-led network, meaning one big corporate decided to do this and everybody else has to get on board, and they're sufficiently large enough in their ecosystem that they could, was Walmart. And so Walmart took food safety and the provenance of foodstuffs and decided that they wanted to reach very deep into their supply chain and be able to assert to their customers that all the way through the supply chain, the federal food safety law requirements were actually being met. So for example, what temperature is the meat being stored at, how long is it being transported for, the cleanliness of the environment that it's in, and so on and so forth. You can imagine where this could go, right? Walmart took initially the pork bellies in China, right, and that was the asset on the blockchain, right? And they were asking everybody who was involved in anything to do with the pork bellies because of fear of contamination of that food supply to assert into the network. Now, we have ways of knowing, right, again, through IoT, through biometrics, through other things, that it is a valid member of their supply chain that's coming into the network and asserting that certain conditions are true. We also have ways through the blockchain of understanding when an IoT, an internet-connected device, is connected to the chain, that is absolutely coming from that device and it's not being spoofed and hacked and so on and so forth. You can trust me on that. People are working very hard on that piece. In fact, let me segue for 1 second because it's so powerful. The Department of Homeland Security had a series of cameras on the Mexican border that were being spoofed. And they had artificial intelligence and other things trying to understand which images were not in fact bona fide. What they did is they worked with a blockchain startup company called Factum, and they made every camera a blockchain, and then they made a blockchain of all cameras. And what they were able to do then, with much less artificial intelligence across that, was be able to create the picture of the entire set of cameras operating as a concert, right? So that they could absolutely deterministically know if one of those pictures wasn't real because the position of the sun is not there at that time when it was there at that time, right? Does that make sense? They're creating a lineage. They're using the blockchain to create continuity between things that should have a continuous representation and view of what the world actually looked like. And so this is a fascinating implementation of IoT plus blockchain. We don't need a wall on the Mexican border, right, if this works. But anyway, so the other example that I like to cite is conflict minerals. In this case, a company called Everledger took diamonds and they the Kimberley laws of the United Nations, and they basically now are asserting putting diamonds on their blockchain so that we could go ahead and figure out, okay, is the blockchain is the diamond that I'm buying, did it come from a blood mine, or is it actually adhering to those rules of the United Nations? Wine tracking, again, a very, very popular use case for blockchain is high value goods or scarce commodities. So for example, wine coming from a certain region, how do I know? What's the way to use the blockchain to figure out that it did come from that producer, it was part of that production, it was from that region, it was from that varietal, and so on and so forth. Gold trading is an interesting one. So a few companies jumped into this space. And what they did is, and it was an interesting model for sort of where this went. They were technology companies that said to themselves, we're going to get into the business of being in regulated trading environments, for example. So they applied for trust licenses from either the DFS or they registered themselves as FINRA broker-dealer under FINRA and the SEC. And the reason why they did that is because they said, listen, for example, in the case of gold, we want to be able to effectuate fractionalized trading of gold bars using this blockchain system. So in this case, the gold is represented as a digital asset on the blockchain. We know that it's backed by a set of gold in a vault. Why? Because Euroclear tells us so, and Euroclear in this case happens to be the custodian who went and verified that. And then we allow people to trade fractional quantities of the gold in the blockchain, and we effectuate what's called delivery versus payment type of a settlement, meaning I have immediate transfer, and this is very powerful in financial services, of the physical commodity, and I have absolute certainty that that payment went along with that value transfer in that ledger. That is a massive problem for securities industry today. Not all asset classes, as you know, settle in that delivery versus payment manner. There's huge credit risk. There's lots of issues of friction in the settlement process, and people do not know, in many cases, where the physical asset is and what associated payments have actually changed hands. So this was a model for, first of all, lots of things, right? First of all, digitizing assets that weren't digital until that point. Also allowing participation of people into the market at lower levels, right, of participation, because now I can fractionalize the commodity, whereas before maybe I couldn't do that. I had to sell it in bigger pieces. And then the other piece is, of course, I have immediate transparency of the physical transfer of the asset and the associated cash, which again is a model for doing that, like I mentioned to you before, even in supply chains, where now I can physically track via sensors that the product is where it's supposed to be, and therefore I have less credit risk, and I have the opportunity to really change how working capital finance is working or supply chain finance is working, because I have certainty of where my goods actually are. So some examples. So we will have time for questions at the end. So I am going to switch gears for a moment and talk about the crypto assets that are being built on top of these blockchains, because I know there's a lot of confusion about how they're linked. But I'm happy to take more questions about blockchain after. But I guess the big takeaway that I want everybody in the room to have is that this is enterprise technology now that's being built out at scale with all of the large technology companies in this town and beyond. They are working on how to take this amazing technology connected to artificial intelligence, connected to big data, connected to industrial Internet of Things, and it will radically change the way enterprise resource planning happens and the way order to cash, procure to pay, all of these huge finance processes that happen inside all of these companies will be radically transformed in the next couple of years based on what we already see. So massive application across, I spent time in Houston with energy companies there, all of them participating in this dialogue and doing things in the space. We spend time with our consumers products group, obviously food safety, other things, really, really important. They're spending time. Pharma companies, again, the notion that you could take continuity of the supply chain of clinical products or regulated pharmaceuticals, for example, and track, huge issue in China, right? We did a lot of work in Asia where there's massive counterfeit in the clinical supply chains. The notion that you could take a patient health record of an individual and that you could provide continuity over every single provider into that record of every single service these are all the things, these are live use cases that we are working on with our clients. I'll give you one more because it's also huge and the amount of money tied up in this is unbelievable. And that is data for the life of insert asset here. So the one that we're leading a consortium on now is aircraft. So that's a massive ecosystem around obviously airlines and airline manufacturers, airplane manufacturers and parts and maintenance and so on and so forth. We brought the industry together and we basically sat down with airlines, we sat down with Rockwell Collins, we sat down with Boeing, we sat down with people who manufacture, fly, maintain and operate the airlines. And we said, imagine if we could have a system, right, that tells us that the plane as specified is the plane as flown, as maintained, and we have a complete log across everybody who touched this thing, including, by the way, I mentioned to you before, the ability to track actors into the system. In this case, if a maintenance worker or a pilot needs to have certain certifications in order to be able to either, provide the service at the airport, when the plane's in the hangar, or to be able to fly the plane, we're also able to check that. So again, and Boeing does lend out pilots, for example, to other airlines. How does that airline know that the credentials and so on of this pilot are up to date? The blockchain can do that. So I just want to leave you with that on blockchain for a moment, that this is absolutely massively transformative across all of these sectors, every single sector that PwC works in. So let's switch the topic to crypto assets. So I told you I used to say I don't want to talk about crypto assets. And I cannot get away with it, and I'll explain why. There's a few reasons. One is nothing to do with the price of Bitcoin. Let me repeat, it has nothing to do with the price of Bitcoin. Why? Because Bitcoin, again, like I said to you, is one particular cryptocurrency, which is a decentralized, distributed, non-intermediated currency, which was intended obviously to replace and work as a store of value and medium of exchange. There are other crypto assets that look like Bitcoin in that context, okay? However, there are other crypto assets that look nothing like that, right? So there are four major, and people will argue with me because maybe you see 5 or 6, but based on the white papers that we see and the coin offerings that are coming to market and the ones that are most actively traded now, we see 4 different potential types of tokens here. We see the ones that I mentioned to you, like Bitcoin, that look like digital currencies. We see the ones that look like they're tokens to a network of some sort. So in other words, the goal of those tokens is to allow participation into some technology advancement, some network, some ecosystem, some affinity group, some marketplace, which is digital, which somebody is bringing into the world, right? So let's call those the utility tokens. We also see what we call asset-backed tokens. So these are, for example, collateralized by something else, whether it's real estate, whether it's actual fiat currency, so it's US dollar or name your currency, or something else. So we even see, and you may have read this week, municipalities saying we're going to take our muni bonds and we're going to actually put them on a blockchain and we're going to tokenize those that way, and they will be backed by verifiable muni bonds, right, and the associated debt. So again, very, very clever ways. We even see real estate companies coming to us and saying, could we sort of reverse ICO ourselves and put the real estate onto the blockchain and therefore increase the participation from a lending and participation into the actual management of that real estate? Could we do that through a blockchain sort of an ecosystem, right? Where again, we're talking about, think about real estate, right? You have the owners of the buildings, the people who are leasing the buildings, the people who are servicing the buildings, the people who are managing the buildings, massive ecosystems, none of which today talk to each other in efficient manners. So again, that would be, in this case, if it were backed by real estate, that could be an asset-backed network. The security token we put on here to be complete. Why? Because, and you know, that the regulatory environment here is really challenging in the United States. Why? Because the SEC has, as you know, shut down some of these ICOs and said, in fact, these ICOs would have violated the Securities Act of 1933. What these ICOs are doing is, in their mind, is they're offering, and I have a slide later that compares sort of IPO and ICO. ICO being the coin offering, which is the presentation to the market of these coins so that people could go ahead and invest in them. The SEC is saying that actually constitutes a securities offering and therefore needs to have the associated disclosures and regulatory requirements that would typically come along with a securities offering. And they're saying that these people who are bringing these things to market are trying to circumvent that and therefore defraud investors and therefore not fulfill obligations that everybody else has to fulfill around disclosures about financial condition and other things. Now, unfortunately, the SEC did not come out, and FINMA, for example, in Switzerland, where much of this activity is now migrating to, the regulator in Switzerland, FINMA, did lay out a very clear set of rules of the road that says if the token looks like this, it is a security. If it looks like this, it is not. That's really helpful. The SEC did not do that. What the SEC did is they shut a bunch of people down. They're now engaged in enforcement. They're going through forensics. They're trying to pick back over what exactly happened. And from that, we will hopefully see some rules being written. Okay? So this is very challenging. Anybody who would like to bring some of these offerings, some of which we think are fantastic, to the market and participate in this method of funding called ICO, initial coin offering, is sort of thwarted at the moment based on sort of where the SEC is going to go next. So why is this market even interesting? Why are we even talking about it? And I mentioned to you this, again, nothing to do with the price of Bitcoin. A big, huge focus, as we know, in the market today is around data ownership. I mentioned it earlier. The breach that happened at Equifax was just a huge manifestation of public outcry of how is it possible that you have centered in some central intermediaries all of this data that could be very, very compromising if there's a cybersecurity threat. The blockchain, again, and these crypto assets, these crypto economies are trying to sort of remediate and fix that problem by not having a central intermediary and by keeping the data, again, in these secure, managed by keys and consensus and other things, so that even if today Equifax was on a blockchain and I was able to hack the network, I wouldn't be able to obtain any more than one record in the chain. The whole chain would not be discoverable to me unless I was a bona fide actor. Public discourse around security, right? So again, the notion that these multi-factor authentication networks are becoming very popular. There is a lot of these white papers that we're reading around ICOs are doing this. They're bringing biometrics. They're bringing higher forms of cryptographic scientist technology into the world, right? They're birthing unbelievably solid theses around how to even in the context of quantum computing, because we get asked that question too. They're working on that. How could we make technology that will protect the networks even in the context of people continually trying to hack them and quantum computing and large amounts of resource being applied to that. The other one that's really important, so when we talk to all of our companies that I mentioned to you earlier that are fascinated with innovation and trying to attract talent around digital and data and everything is a digital asset, what do they need to effectuate that, right? They need to buy developers. They need developers. The amount of people that need to go out to the market and hire this sort of creative developer skill set, right, that understands customer behavior, but also understands agile technology, that also understands these new emerging technologies, but also understands how to connect that to the existing enterprise and the legacy that's there. This is a really difficult skill to find on the market. And so what's happening is these developers that are coming up with these sorts of tools that say, we're going to give you the ability to benefit from blockchain, but we also understand how to connect back to your enterprise resource planning systems, for example, your SAPs of the world. Those developers are coming up and saying, I could do that for myself. I can monetize that myself. I can get together with a couple more guys. We're all technologists. The problem is, of course, they're not regulators and they're not business people, but that's where consultants and other people come in. But they get together and they say, this is a viable commercial opportunity actually for us. And that's why these tokens are coming to the market. Now, I mentioned to you as well, it's obvious, the entrepreneurial mindset is moving faster and grasping the technology than the regulators can keep up with. Huge problem in the United States. Massive problem in the United States. And we're very worried about this. I'm very worried about this. This is a personal opinion, right? That the United States will fall behind here. And this technology talent will just drift overseas because there's a framework. There's a framework that says you can do it, but this is the context of operation, right? We don't have that here at the moment. And then the decentralized network. So enterprise assets, including people, as you know, the lines are getting blurred. So many people use contingent workforces. That's becoming even more sort of on-demand use of contingent labor. Again, how does that ecosystem work? If I'm going to use on-demand contingent labor, how do I know if it's a regulated industry that the person has the appropriate licenses, certifications, and so on and so forth? Again, these networks are being built up to answer that question for you. So this is an interesting slide to tell you that, again, it's not just about the price of Bitcoin. So let's say there are 1,500 odd of these tokens that are actively traded and have deep enough liquidity in the market and sufficient trading activity. A third of those tokens are these utility tokens. So they have nothing to do with trying to even supplant Bitcoin. They have nothing to do with getting governments out of managing currencies. Nothing to do with that. What they have to do with is bringing to market unbelievably interesting and innovative technology that lots of people out there are willing to invest in and believe. So we talked about ICOs. Again, a year ago we would have said, well, what's the big deal, right? It's not really that interesting. Well, it got really interesting, right? When $5 billion went to the ICO market, and we had VC clients of ours calling us up and saying, what does it all mean? Does this mean angel investor and then ICO and then no VC funding? Like what, right? This is a very fair question. We don't know. We're about to produce a little thought leadership piece. I'll make sure that people get it and can distribute it. But it sort of shows that model of like, again, how does entrepreneurial funding actually work in the future? Where does it go? Because this is very staggering. We wanted to show a couple of differences, and again, this is where the SEC is very fascinated, of course, and I mentioned some of these things. So in the ICO, there's no specific regulatory framework. So everybody's going overseas to try to figure that out, right? Do regulatory arbitrage and figure out what's the host country that's going to be most receptive, given that I can manage the tax implications of doing that and where my founders live and everything else. So that's very interesting because, of course, IPOs, it's a very distinct and specific market that you're offering into with a very distinct set of rules around that. It's generally an early stage company. So again, if I'm VC, I'm kind of really having to pay attention to that, right? Because that's where people are coming in on these offerings. And the funds are for a very particular purpose. In other words, there is a white paper that says this is where the money is going to go. Now, of course, there are lots of questions about, well, hang on a minute, what if I'm a shareholder? And then there's a token holder. Is this a dilutive effect? Like, what happens here, right? All good questions. And again, this is why the SEC, I think, is taking the position that they're taking. We don't even really know what happens in the case of a bankruptcy where there are debt holders, equity holders, creditors, and token holders. Where does the token holder fit in that waterfall? I have no idea. But again, you have more flexibility, right, in this ICO model to do what we're calling sort of almost like the reverse ICO now, where, so a gaming company was in our office last week, and they have 17 million customers in the gaming company, and they allow you to have wallets, right, where you can sort of pre-fund, so stores of value on their network, where you can pre-fund your character and all the enhancements that you're going to buy for your character and whatever else you're doing. They came to us and said, gee whiz, wouldn't that be really interesting if we could take that store of value and we could actually have, an ICO, so we could leverage it, and we could have people prepay, if you like, to fund the next gen of our actual video game software. Very, very interesting, right? You would argue that that's really for the benefit of all the members of that network, and then that's a good thing. But again, if you're the SEC, you might shut that down and say that actually, again, that's a securities offering, right? And if the goal is not to disclose information related to how those funds are being used and how the performance is and so on, then in fact the investor may not be protected. So again, I'm not asserting who's right and who's wrong here. I'm just saying these are sort of some of the complexities that exist as we sit here today. So again, just to sort of be comprehensive about it, we do think there's some quite significant advantages if you're an early stage, entrepreneur of using this method. And a lot of it does come down to as well, and this, right, that the pre-sale for these things, they're using social media channels, they're getting out to their affinity groups, so to speak, and they're really trying to, again, attract who are the people who will benefit when we build this thing, and how do we get them on early. And so many of them are obviously very nobly trying to do that, even if the SEC is saying that they should be shut down, right? And the interesting thing is that they're able to, right? The social media channels are there, the investors are there, the people who are on board to commit, right? We see it, obviously we see huge amounts of money being raised, right? And you have an ability to sort of fund that ecosystem as you're developing it. So just very quickly, again, what would you need to look at if you're looking at investing in an initial coin offering? What are some of the things? Some of these are very similar to what you would look at, obviously, in the case of an IPO. They're identical. But the things that become a little unique and require more of your attention would be this white paper. So the white paper is the prospectus, the offering, however you want to think about it. It's the description of what's about to be built, so that you have a participation stake into that thing that is described in the white paper. Now, we would look for, if we were looking at the white papers, we would look for, has the token been correctly classified? Is the blockchain technology underneath sound? Do we understand how the smart contracts will operate to actually manage the tokens moving around the network and not double spend them and things like that? So we would be looking for those sorts of things. And in fact, we haven't started doing it yet, but because again, the situation in the United States is we're not mature enough. But there's an opportunity here, obviously, to be providing diligence around that for people who do want to invest, to be able to say, this is the diligence that was performed, this is what's actually happening here. And then, of course, how is that token, how does it actually get distributed at the point in time when the funds are received, and so on and so forth? Is that orderly, etc.? Regulatory, obviously, would require a huge, consideration here, bigger than, obviously, your IPO, because, again, we don't know the rules of the road. We have to look at the regulatory environment that the token's been issued in, and we have to understand, what is the approach that regulatory body actually has, and so on and so forth. So if that's the opportunity, I guess, not to end on a downer, but to tell you that this is sort of the reality. And look, the markets were, as we know, very frothy, right? When around the holiday period, when SIBO and CME actually issued derivatives contracts over Bitcoin. Of course, everybody said, oh my God, that's giving credence to this market, institutional money sitting on the sides, it's going to come. What we also know happened was that over 100 registered investment advisors registered their intent in this country with the SEC to get into crypto funds. And you may have seen the letter from the SEC in August to SIFMA and ICI basically saying, shut it down. Shut it down because any registered fund, ETF, mutual fund, whatever, will have to demonstrate that they can still comply with the 1940 Act, and therefore we do not know how they would do that in the context of calculating a net asset value, demonstrating liquidity for intraday redemptions, et cetera, et cetera, et cetera. So they laid out all the areas of consideration. So the point here is the regulatory environment is uncertain, right, around these things. The cybersecurity issue is still there. There's still these exchanges being hacked. You have these cold wallets and hot wallets. The hot wallets are the sort of online tokens. Those have been hacked and stolen, and so this is still a reality. If the exchange infrastructure that you're dealing with is not mature, what are you supposed to do? And then obviously, how will the tax authorities react? We know the IRS has already come out with some statements around, again, if you change from crypto to fiat, that's a cap gains event. Everybody was very shocked about that, but that was the position they took. And then they went after people at Coinbase who had done that and obviously sought to make people good on their taxes. So let me stop there because I'm sure that there are questions in the room. I said a lot. I tried to keep to the time frame. Everybody's completely overwhelmed. Yes, sir.
Wow. Please, round of applause, please. Here, this fantastic content. And let's try and get a few kind of rapid fire questions. I know we've got a few. Go ahead, right here.
Yeah, so Canada has been really actually very aggressively looking at digital currencies for the Bank of Canada to be the issuer of the digital currency. So they went very far down that path. They had a proof of concept. They came back and they said they're going to wait until the technology underneath gets to the point where they feel secure that they could operate, themselves using a digital currency for, in their real-time payment system and other things. Yes, Montreal as a fintech center, for example, has been quite active again in welcoming blockchain and welcoming. Have they come out? We did a rundown of every single country and how they've classified crypto and what they've said about it. And I don't remember how Canada classified it, but I could send that out if that's public information, if that's of interest.
Be great. Go, Grainne.
Great firm, you're associated.
Thank you. I tried not to mention them. This was not a sales pitch.
And so what do you stand behind? I mean, obviously you have corporate lawyers. How can you, and we're not demonstration, but how can you support some of the cryptocurrency emergence? Or will you focus just on blockchain?
No, so we absolutely are focused on trying to help sponsors who are bringing ICOs to market as well in the jurisdictions where we have clarity. So for example, in Asia, we've led 30 of them. And so what do we do in there? We do everything that I showed you on that honeycomb diagram. We look at the governance, we look at the tax implication, we advise the owners on the tax implications. We examine the smart contract. We give advice on the governance and what it should be. We try to future-proof them to the extent that somebody could turn around and say this was a securities offering. KYC, obviously, an obvious one, right? Anybody who isn't doing KYC, we can't deal with them, right? So we do, and you'll have seen that as well, that FinCEN has said that these ICOs have to have KYC and are under the BSA and AML rules. And so we look at that. We explain what those are to people if they want to offer for sale in the US.
What's your comfort level now? I mean, you're not gravitating to obviously ICOs. Do you prefer blockchain or
We're all over blockchain. Yeah. ICOs is developing in the U.S. a little more mature in some of our other jurisdictions because the government there is more welcoming and more mature in the regulatory framework. Yeah.
Good, Ken. We'll go to the back.
You were comparing IPO and ICO. If I were doing an IPO, I'd go out and get an investment banker. They put a syndicate together.
Absolutely.
They would put a market together with all their current
Yep.
clients. You would hope that you would create some liquidity pretty quickly. How do you do that with the ICO?
So they're using social media channels. In fact, Alex, you're here. Do you want? Yeah, go ahead. Do you want to respond? Because you've done this.
Well, we'll be on a panel in a few
Yeah.
minutes, so
Okay.
we'll talk about this.
Perfect. So you'll do that.
Many
But
channels.
yeah, they pre-sell to their network through social media. It's unbelievable. It's unbelievable. You
Go ahead
don't
in the
even need
back.
a banker.
So I have a real specific question within this model. There's a lot of talk about companies raising more money through ICOs than they're raising from venture, at least in some segments of the market. But if I'm a company raising money through an ICO, what do I have? I mean, I have a bunch of tokens, but I run my business on another currency that's more
convertible.
acceptable.
They're convertible. You can list them on the exchanges and trade them for other things.
So I can trade them in.
Yeah.
But my other question is, there's so much volatility in the pricing of these things.
Yeah.
How do I create a valuation around that, and how does it relate to the rest of my cap stack?
That's exactly the problem. I totally agree with you. And that's why even the SEC is saying, look, you can't. No funds can trade them because we don't know what the NAV is. We don't know what the price is. The market is not there in terms of being able to tell us the maturity of the pricing and liquidity. So I agree with you. It's a big challenge, and I just mentioned that, which I totally agree with as well. Is we don't actually understand what the rights of the token holder are versus the rights of a shareholder, for example, if they coexist.